Welcome to our deep dive into the economics of climate change. In this video, we'll explore how climate change isn't just an environmental issue, but a profound economic challenge affecting individuals, businesses, and governments worldwide. From rising costs to shifting markets, the impacts are far-reaching. We'll break down the key concepts, examine real-world examples, and discuss the policies shaping our future. Let's begin by understanding why economists are so concerned about climate change and how it's reshaping the global economic landscape. Before we dive into the economics, let's clarify what climate change means. Climate change refers to long-term shifts in temperatures and weather patterns, mainly caused by human activities like burning fossil fuels. These changes are leading to more frequent extreme weather events, rising sea levels, and disruptions to ecosystems. Understanding these basics is crucial, as the economic consequences stem directly from these environmental shifts. Now let's see how these changes translate into economic terms. Climate change affects economies in multiple ways. It damages infrastructure, disrupts agriculture, and increases health costs. For example, hurricanes and floods can destroy roads and homes, requiring expensive repairs. Droughts can reduce crop yields, leading to higher food prices. These impacts are not limited to one country, they ripple across global supply chains and markets. Next, we'll look at how these damages are measured and what they mean for economic growth. Economists categorize climate change costs as direct and indirect. Direct costs include immediate damages like rebuilding after a storm. Indirect costs are less obvious, such as lost productivity due to heat waves or increased insurance premiums. Both types of costs add up, straining public budgets and private finances. Understanding this distinction helps policymakers design better responses. Let's explore some examples of each to see how they play out in real life. Agriculture is one of the sectors most vulnerable to climate change. Changes in rainfall, temperature, and extreme weather can devastate crops and livestock. This leads to lower yields, higher food prices, and increased food insecurity, especially in developing countries. The economic ripple effects can be severe, affecting everything from local farmers to global food markets. Next, we'll examine how businesses are adapting to these challenges. Businesses are responding to climate risk by investing in adaptation strategies. These include developing drought-resistant crops, improving supply chain resilience, and adopting sustainable practices. While these investments can be costly upfront, they help companies avoid bigger losses in the future. Some businesses are also shifting to green technologies, which can open up new markets and revenue streams. Let's look at how these strategies are changing the business landscape. The insurance industry is on the front lines of climate change economics. As natural disasters become more frequent and severe, insurance claims rise, leading to higher premiums and in some cases reduced coverage. This affects homeowners, businesses, and governments alike. Insurers are now using advanced data analytics to assess risks and adjust their models. These changes are reshaping how we think about risk and protection in a warming world. Climate change also brings significant health costs. Heat waves, air pollution, and the spread of diseases all contribute to higher healthcare expenses. Vulnerable populations such as the elderly and children are especially at risk. These health impacts can reduce workforce productivity and increase public health spending. Addressing these challenges requires coordinated efforts from governments, healthcare providers, and communities. Infrastructure, roads, bridges, power grids is increasingly vulnerable to climate change. Floods, storms, and heat waves can cause extensive damage, leading to costly repairs and disruptions. These events can also interrupt essential services, affecting economic productivity and public safety. Investing in resilient infrastructure is becoming a top priority for many governments and businesses, as they seek to minimize future losses. Climate change doesn't respect borders. Extreme weather events can disrupt global supply chains, affecting the flow of goods and services. For example, a flood in one country can delay shipments worldwide, impacting manufacturers and consumers alike. These disruptions highlight the interconnectedness of our economies and the need for international cooperation to build resilience. As climate change makes some regions less habitable, people are forced to migrate. This movement can strain resources in receiving areas and disrupt local economies. Migration also affects labor markets, housing, and public services. Economists are studying how these shifts will shape economic development in the coming decades, emphasizing the need for proactive planning and support. One key concept in climate economics is the social cost of carbon. This measures the economic harm caused by emitting 1 ton of carbon dioxide into the atmosphere. It includes damages to health, agriculture, and property. Policymakers use this figure to evaluate the benefits of reducing emissions and to set carbon prices. Understanding the social cost of carbon helps guide effective climate policies. To address climate change, many countries are implementing carbon pricing mechanisms. These include carbon taxes and cap-and-trade systems. By putting a price on carbon emissions, these policies encourage businesses and individuals to reduce their carbon footprint. The revenue generated can be used to fund clean energy projects or offset costs for vulnerable communities. Let's see how these mechanisms work in practice. Investing in renewable energy is a key strategy for reducing greenhouse gas emissions. Solar, wind, and hydropower projects are attracting significant capital worldwide. These investments not only help combat climate change but also create jobs and stimulate economic growth. However, transitioning to renewables requires upfront costs and careful planning to ensure reliability and affordability. Shifting from fossil fuels to renewable energy isn't easy. It involves technical, financial, and social challenges. Some regions depend heavily on coal, oil, or gas for jobs and revenue. Transitioning requires retraining workers, investing in new infrastructure, and managing economic disruptions. Policymakers must balance environmental goals with economic realities to ensure a just transition. Shift to a low-carbon economy is creating new job opportunities in sectors like renewable energy, energy efficiency, and environmental management. These green jobs offer potential for economic growth and social development. Governments and businesses are investing in training programs to prepare workers for these emerging fields, ensuring that the benefits of the green transition are widely shared. Climate finance refers to the funding needed to support mitigation and adaptation efforts. This includes investments in clean energy, disaster resilience, and sustainable agriculture. Both public and private sectors play a role, with international organizations providing support to developing countries. Effective climate finance is essential for achieving global climate goals and protecting vulnerable communities. Global cooperation is crucial in tackling climate change. International agreements like the Paris Agreement set targets for reducing emissions and mobilizing climate finance. These agreements encourage countries to work together, share technology, and support each other's efforts. While progress has been made, challenges remain in ensuring that commitments are met and that all countries benefit. Climate economics, adaptation and mitigation are two key strategies. Adaptation involves adjusting to the impacts of climate change, such as building flood defenses or developing drought-resistant crops. Mitigation focuses on reducing greenhouse gas emissions to limit future warming. Both strategies require investment and careful planning, and their costs and benefits must be weighed by policymakers. Economists use cost-benefit analysis to evaluate climate policies. This involves comparing the costs of action, like investing in clean energy, with the benefits, such as avoided damages and health improvements. While these analyses can be complex, they help policymakers make informed decisions about where to allocate resources for maximum impact. Key debate in climate economics is the use of discount rates, how we value future costs and benefits compared to present ones. A higher discount rate means we value the future less, which can justify delaying action. A lower rate places more importance on future generations. The choice of discount rate has major implications for climate policy and investment decisions. Climate change involves significant uncertainty and risk. We can't predict exactly how severe the impacts will be or when they'll occur. This uncertainty makes it challenging to plan and invest. Economists use risk assessment tools and scenario analysis to help guide decisions, emphasizing the need for flexible and adaptive policies. Climate change is a classic example of market failure, where the true costs of pollution are not reflected in market prices. These unpriced costs are called externalities. Governments intervene through regulations, taxes, and incentives to correct these failures and encourage more sustainable behavior. Understanding externalities is key to designing effective climate policies. Innovation plays a crucial role in addressing climate change. New technologies such as advanced batteries, carbon capture, and smart grids can reduce emissions and lower costs. Governments and businesses are investing in research and development to accelerate these breakthroughs. Supporting innovation is essential for achieving long-term climate goals. Behavioral economics examines how people make decisions about climate change. Factors like risk perception, social norms, and incentives influence whether individuals adopt sustainable behaviors. Policymakers use insights from behavioral economics to design programs that encourage energy efficiency, recycling, and other climate-friendly actions. Climate change often worsens economic inequality. Poorer communities are more vulnerable to climate impacts and have fewer resources to adapt. Addressing these disparities requires targeted policies such as financial assistance and investment in resilience. Ensuring a fair transition is a central challenge for climate economics. Cities are both major contributors to and victims of climate change. Urban areas face unique challenges such as heat islands, air pollution, and flood risks. Investing in sustainable urban development like green buildings and public transit can reduce emissions and improve quality of life. Urban planning is a key area of focus for climate economists. Natural disasters linked to climate change, like hurricanes, wildfires, and floods, cause massive economic losses. Recovery efforts require significant public and private investment. Building resilience and improving disaster response can reduce long-term costs and protect vulnerable populations. Let's look at how recovery strategies are evolving in response to climate risks. Biodiversity loss is another economic consequence of climate change. Healthy ecosystems provide valuable services like pollination, water purification, and flood control that support economies. Protecting biodiversity is not just an environmental goal but an economic necessity. Economists are working to quantify these benefits and incorporate them into policy decisions. Water scarcity is a growing concern as climate change alters rainfall patterns and increases evaporation. This affects agriculture, industry, and households, leading to higher costs and potential conflicts over resources. Efficient water management and investment in new technologies are essential for adapting to these challenges. Oceans play a vital role in regulating the climate and supporting economies through fisheries, tourism, and shipping. Climate change threatens these benefits by causing ocean warming, acidification, and sea level rise. Protecting ocean health is crucial for sustaining economic growth and food security in coastal regions. Tourism is highly sensitive to climate change. Destinations may become less attractive due to extreme weather, sea level rise, or ecosystem loss. This can lead to job losses and reduced revenue for local economies. Diversifying tourism offerings and investing in resilience can help mitigate these risks. Financial markets are increasingly factoring in climate risks. Investors are assessing companies' exposure to climate impacts and shifting capital towards sustainable assets. Regulators are also requiring more disclosure of climate-related risks. These trends are reshaping investment strategies and encouraging more responsible business practices. Central banks are beginning to address climate risks in their policies. They are analyzing how climate change could affect financial stability and considering green criteria in their asset purchases. By integrating climate considerations, central banks can help steer economies toward more sustainable growth. Companies are under increasing pressure to disclose their climate risks and strategies. Transparent reporting helps investors, regulators, and the public understand how businesses are managing climate challenges. Standardized disclosure frameworks are emerging to ensure consistency and comparability across industries. Consumers are increasingly making choices based on environmental concerns. Demand for sustainable products and services is rising, encouraging businesses to adopt greener practices. This shift in consumer behavior is influencing markets and driving innovation across industries. Education is vital for building awareness and skills to address climate change. Schools, universities, and training programs are integrating climate science and economics into their curricula. An informed public is better equipped to make sustainable choices and support effective policies. Transferring clean technologies from developed to developing countries is essential for global climate progress. Technology transfer helps bridge gaps in capacity and resources, enabling all countries to participate in the green transition. International cooperation and funding are key to making this process effective. Both public and private investment are needed to address climate change. Governments provide funding for research, infrastructure, and social programs, while private investors drive innovation and scale. Effective partnerships between sectors can maximize impact and accelerate progress toward climate goals. Legal action is becoming a tool for addressing climate change. Individuals, organizations, and governments are suing polluters and demanding stronger climate policies. Climate litigation can drive accountability and encourage faster action, but it also raises complex legal and economic questions. Nonprofits and NGOs play a vital role in climate economics. They advocate for policy change, support vulnerable communities, and fund innovative projects. Their efforts complement those of governments and businesses, helping to drive collective action and raise public awareness. Tracking progress on climate goals requires reliable data and indicators. Economists use metrics like emission reductions, renewable energy adoption, and resilience improvements to assess success. Transparent reporting and regular evaluation help ensure accountability and guide future action. Economists use scenario analysis to explore possible futures under different climate policies. These scenarios help policymakers understand the trade-offs and risks of various choices. By planning for a range of outcomes, societies can better prepare for uncertainty and change. We've covered a lot of ground in exploring the economics of climate change. From direct costs and market failures to innovation and policy, it's clear that economic thinking is central to addressing this global challenge. By understanding the financial impacts and opportunities, we can make smarter decisions for a sustainable future. The economics of climate change will continue to evolve as new technologies emerge and policies adapt. Staying informed and engaged is essential for individuals, businesses, and governments alike. By working together and investing wisely, we can build a more resilient and prosperous world for generations to come.